When you buy a stock, it should be because all of the work you've done on it is lining up. You understand the business model. You understand what it's going to look like in 2 or 3 years or longer. And you understand what factors are going to affect that. Competition, new product lines, market conditions, whatever. You understand the financials and how the company's doing, and you see something that supports your argument for where the company is going. You understand the current price and you think that it's a reasonable price to pay for what you're going to get from this company in the years ahead. Or even better, it's a steal. The last thing to do is to put it all together, to understand what is your opportunity here if you're right. How wide is the disconnect between the price and what you think the value should be? What's going to change the market's mind to convince them that the price you think is worth paying is indeed going to be worth paying for the shares? And what happens if you're wrong? Let's put all these elements together and talk about making the case to buy a stock. Let's start with 4 general categories for how shareholders get rewarded in the stock market. Why their shares end up being worth more. There's more out there, but I thought these 4 categories would make it simple. First is you pay X dollars per share, and then you get more than X dollars back from the company directly in the form of dividends. This is relatively rare. It would be under a special situation category, or it comes if you've held a company's shares for 10, 15, 20 years. It's worth thinking about, but it's not a normal category. Then there's earnings growth. If you pay 10 times earnings for a company, and those earnings double in 5 years, and you're still paying 10 times earnings at the current share price, then your shares have doubled. They've doubled as the earnings have doubled. The denominator is doubled, the multiple is the same, so the share price has doubled. Then there's the flip side of this, which is the multiple expanding. In multiple expansion, let's say the earnings don't change, but whereas the market used to think they were worth 10 times, they decide that actually they should be worth 20 times. Again, the share price doubles in that scenario. And then the fourth example is where another company or entity buys the company out, and you just get a quick payday. It's very hard to predict buyouts, and that first scenario of capital return of getting all your money back in dividends is relatively rare. So we're going to say that most ideas fall somewhere on a spectrum between earnings growth and multiple expansion. Again, there's different flavors of that, but that is the general spectrum for most investing ideas. Let's take an example of a company with 9 times earnings, let's say. You're paying $9 for $1 a share in earnings. Why would that be? That's much less than the market multiple of 16 to 20 times earnings. Probably it means that many people in the market think those earnings are going to go away. Maybe the company is suffering competition. Maybe they just aren't growing anymore. Maybe it's a cyclical company. Cyclical companies are dangerous because their price to earnings multiple is usually highest right before their earnings collapse. Their earnings go up and down over 3-5 years, whatever their cycle. And so it's very easy to get suckered in with a low PE multiple and then find that you're paying a lot more because the earnings have declined. Now let's take our $9 a share company, and let's say that it actually manages to grow its earnings 3 years in a row. Steady growth in its earnings, and now all of a sudden it's earning $1.50 a share. For that $1.50 a share, let's say the market says, okay, now this is a secular grower, which is the market's favorite thing. We think that this will grow outside of cyclical effects. We're now willing to pay 15 times earnings. Your multiple has expanded 66%, and your earnings has expanded 50%, and together the share price is now going to be 22.5. You have seen 150% returns in these 3 years. On earnings growth of 14% a year, you got share return of 35% a year. Not bad. That's an illustration. Let's take a real example. TJX was trading 18 times earnings in early 2013. Since then, in a decade, it's grown its earnings about 10% a year, just a little bit less. It's returned as a stock 14% a year, and that's not counting its dividend that it's paid out. Meanwhile, the S&P 500 has grown 11% a year. Given all that, it should be no surprise that its multiple has also expanded. Its multiple is now 26 times, more or less. So you have multiple expansion and solid earnings growth driving a 14% return in shares, which is a meaningful number. When you're reading or studying a stock and you're thinking about buying it, you need a case for why things will get better than they are now, or why things are good enough now and will stay as good as they are now. Either way, you're trying to anticipate where you could be right and the market wrong. Because even in the good enough scenario, if the shares are attractive, it means that the market doesn't think that things will stay good. You can drive yourself crazy trying to figure out what your edge is or how you think that you're smarter than the market. Because there's so many smart people out there and there's so much out there. But it can also be simpler than it seems sometimes. Doesn't mean right. But I'm going to give you a couple examples. They're not investing advice, but they're just ways of how you can capitalize on whether you have a differing view than what's in the market. I've mentioned Charles Schwab a couple times on these videos because Charles Schwab is an easy example to me of potentially a great company that is on sale for a temporary issue. The banking crisis in March was real and highlighted a real issue. Due to the rapid rise in interest rates, Charles Schwab is likely to make less money this year than was previously expected. Shares dropped almost 50%, and they're still about 33% below their highs of earlier in the year. That doesn't mean anything. It could be that the highs were wrong, not the drop. At the same time, my argument is that Schwab's earnings will be as good or better than they were before this year, 2 or 3 years from now. And in the meantime, they're still going to be profitable. So they won't suffer dramatically in the current environment, and they'll rebound to where they were before, which should also boost their multiple back to something close to where it was before. So I will get earnings growth and a multiple re-rate to where it used to be. I bought Spotify shares last fall. I've been following Spotify since they became public, 5 years or so ago. I understand the business model, which is subscriptions to listen to music, along with advertisements for podcast listeners and free listeners. And the free listeners are then acquired into becoming paid customers. And then they have a few smaller things, but that's the main business. Its shares have usually been expensive. It's a tech company, it's new wave, it's on everybody's phone, so we're all Peter Lynch investors deciding whether Spotify is cool or not. And so it was hard for me to invest in shares for a long time. I always felt like I was paying a lot. Spotify is essentially just recreating radio and maybe the recorded music industry. We can figure out how much it's worth, and it wasn't worth what the shares were selling for a long time. Last fall, the shares became more attractive. I was paying for shares between $75 and $95 a share, roughly. That was an enterprise value to sales of 1 to 1.3 times. I thought that was reasonable because I thought that Spotify didn't need to raise money. It was self-sustaining, it was stable, so I was comfortable with its business from that perspective. And I thought there was a reasonable chance that Spotify could maintain its lead as an audio-focused company against more diversified competitors like Apple, Amazon, or Alphabet via YouTube. So at that point, I thought I had a reasonable case, and I bought shares last fall. I did not expect the shares to double in about 6 or 7 months, but that's the sort of year 2023 has been. And I should say, I have sold a few shares since. I'm going to now move from these two examples and share a couple market cliches to help illustrate what's been happening or what I was trying to apply and what happens in general when we're buying stocks in the market. Mr. Market is Benjamin Graham's creation. Benjamin Graham, the founder of modern value investing, Warren Buffett's mentor, had this concept for Mr. Market, a relatively unstable guy who will come over and say, hey, I want your shares for $20 today. And then tomorrow he'll say, hey, I'm buying the shares for $30 a share. And then on Friday, he'll say, actually, I'm selling them for $10 a share. You never have to transact with Mr. Market. Instead, you can wait until he goes to the extremes. And that's where you get opportunities. You buy when he's offering shares for very cheaply, and you sell when he's offering to pay a lot for those shares. It's a little bit of a hokey metaphor, but it does illustrate that market sentiment can swing wildly from day to day, week to week, and there are opportunities for patient investors. Buying a stock is risky. And above all, the biggest risk is just that your work is wrong, that you misunderstood the business model. In my case, that Schwab's issues run much deeper than just a temporary problem, or that Spotify is actually getting outcompeted by the giants that are around them, or an issue that I wasn't even thinking about. There's always the chance that no matter how hard you work at understanding something, you misunderstand it. Even given that, I don't want you to think that your work is not worth putting into this practice. What you need to do is think about, well, how could this be wrong? If things go wrong, what happens? Spell out the worst case scenario. If interest rates stay high and Schwab is not able to recapture their net interest margins, what does their business look like? How do they manage to cope with that? Or conversely, if we go into a recession and interest rates get cut again, how does that affect Schwab's business? How will they manage in a lower rate environment again, where they don't have as much margin to raise net interest margin? You want to develop a bad case scenario, what is commonly called a bear case scenario, and try to be honest with yourself and think through what would that mean to the shares of the company. You should also develop a bull case scenario, what you think could go right. Schwab can have more margin to build their net interest margin, and their brokerage assets under management increases because everybody goes Schwab and they end up earning more than expected. Spotify ends up growing subscriptions faster than expected and raising prices faster than expected. And all of a sudden they're making positive earnings next year instead of 2 or 3 years from now. Whatever. Those are just hypotheticals, but develop a bull case scenario. Then you compare the scenarios. You compare the reward that you might earn in the bull case scenario with the risk that you might have in the bear case scenario. Ideally, you want to invest in cases where it's asymmetric, where the reward is much more meaningful than the risk. You want to get to the point where you're in a heads I win, tails I don't lose much situation. That's hard to do. And again, it's all prone to your own error. You might say that that's the risk, but you might be totally wrong. But you want to be thinking in this mindset. And you want to leave yourself in positions where the risk reward is attractive so that when you get it wrong, you're not hurt too badly. And when you get it right, you get rewarded meaningfully. Again, Benjamin Graham has a good concept for this, but I want to save that for its own video. So we'll go to that later. As you're getting started as an investor, it's okay to make experiments and make small investments. You want to start getting a sense for what works for you. What type of company do you feel comfortable buying? Do you like buying the giant that is temporarily wounded and maybe that will pass? Do you prefer to buy the hot, young, upstart company that's growing faster than anybody can predict? Or do you just like things that are cheap and want to stick to the cheaper stuff? Whatever it is, you can find your style, take small investments, control your risk, don't go crazy, and see what feels right to you. See what strategy you can stick to over time. But as you get more experience, it's worth building up your patience. There's another metaphor from Warren Buffett that is worth keeping in mind. It comes from baseball. The idea is there are no called strikes in investing. Your friend will tell you about how he or she invested in this stock and it went up 500%. You'll read about NVIDIA and how it's tripled so far this year. You'll hear about all these opportunities and you'll feel the FOMO. You'll feel that you're missing out. But none of that counts against you. You don't need to pick every winner. You will miss out on thousands of winners, if not millions, in your investing career. You just need to find the winners that make sense to you. And so instead of trying to swing at every pitch, you can wait until there is a fat pitch, a nice juicy meatball right down the middle where you understand the business model, you understand the price, you understand why the market is wrong, you have a good argument for why it's going to get better. And if you miss, you're not going to get hurt too badly. That is waiting for a fat pitch. Again, at the beginning of your career, it's okay taking swings because you need to learn how to recognize that fat pitch. Nobody just walks up to the plate and hits a home run. So you have to take some swings, get a feel, see how far you can hit the ball, see how much it hurts when you miss, and so on. But as you build that experience, it's worth remembering that just as a lot of our money will be made in the holding and adding to stocks and waiting, patience in buying stock is also a great virtue and also worth keeping in mind. We've gone over 4 steps to evaluating a stock before you make the buy. There's going to be one more video where I go over some miscellany categories that we haven't touched upon yet that don't deserve their own video, but that are worth keeping in mind. After that, I'll go through a couple videos on where to actually find the materials to answer all these questions. How do you find the financials? How do you find the business model? How do you find the price and arguments over the valuation? And then I'll start sharing what I personally look for when I'm looking at stocks. Some of it has been mentioned here, but I'll put it in a more rigorous format. And then we'll go over a lot of examples. Things I have done in my investing, things other famous investors have done in their investing, and so on. Stay tuned to this channel. There's a lot more to come. So subscribe, check out shortinvestingguide.com, get more of the written materials and all of this. Thank you for watching, and see you next time.